Hi, everyone, and welcome. Thanks so much for joining us today. Whether you're an AlphaSense customer or a new guest, we're glad to have you here for today's session, Data Center and Energy Transition's Impact on the Oil and Natural Gas Markets. I'm Doug Garber, founder of Pitch the PM and your host for today's discussion. I'm excited to be joined by Arjun Murti, partner at Veriton, who brings over 30 years of experience on Wall Street covering the global energy sector. This webinar is sponsored by AlphaSense, the market intelligence platform that brings together all the qualitative market perspectives you need, with access to over 500 million documents, including 200,000 expert interview transcripts, plus company filings, event transcripts, news trade journals, equity research, and more. AlphaSense also offers generative AI tools built to surface qualitative investment insights at scale, helping investors and analysts move faster and go deeper. With that, let's jump into the conversation with Arjun. Arjun, before we start today, can you give us a quick background of what you do at Veriton and what you were doing for the last 20, 30 years of your career that brought you here?
Sure, Doug, and thank you for having me, and thank you to AlphaSense as well. Let me just fix the camera. It's a real pleasure to be here. I've got over 30 years of kind of background. I really identify as an equity research analyst. I started at a small investment bank in Denver. I was on the buy side for a little bit, and the heart of my career, and I think where we met was at Goldman Sachs, where I was for 15 years. And frankly, during the last super cycle, which I think we'll get to, I stopped at Goldman in 2014, and then have been doing board and advisory work since then. And then in the last 3 years, I've started writing a blog called Super Spiked. It's for free and accessible on Substack and at the Veriton website. And I also joined a company called Veriton full-time. It's founded by former Goldman colleague of mine, Maynard Holt. And between the other folks at Veriton, they've either worked together at Tudor, Pickering, Holt, where Maynard had co-founded that firm, and they're now at Veriton, or we've known each other over the course of our careers, and really focus on helping companies think through macro strategy, these kind of questions. We have a investment fund focused on energy and industrial technologies, and been doing that about 2.5 years now, and still doing some of the board and advisory work as well.
Great. Well, thank you for taking the time to be here, and our timing is phenomenal. You recently just put out a report called The Power Super Cycle, the third super cycle of our lifetime. I'd love to get your thoughts behind that and what inspired you to make this bold call at this point.
I mean, so I kind of said in my lifetime. So the first one was the Arab oil embargo, which was in the early 70s. I was a kid at the time. It was one defined by geopolitical conflict. The rich, or the oil rich, I should say, Middle Eastern countries withholding oil supply, primarily to the US and Europe as well. And it was a real sense of sort of oil was at the center, and geopolitical turmoil, geopolitical security was kind of the outcome of that. And it has led to a bunch of different ramifications on demand and supply and so forth. And I think a lot of countries, even if they weren't impacted by that 1970s embargo, it still conjures up sort of really bad memories for people, whether they were directly or indirectly involved. And I think still dominates a lot of how people think of the world. The second super cycle was during my time at Goldman Sachs. It was the China BRICS expansion. And we had made, my team and I, a big call on oil at the time that was going to move from the $20, $30, $40 range it had been at to eventually over $100 a barrel. And the thought there was China and BRICS are leading a real surge in oil demand and global GDP growth, all at a time the kind of easy oil supply that had come out from that 1970s cycle was starting to peter out. And it wasn't that the world was running out of oil, but that you were going to have to go through a CapEx cycle. But I would say that was, again, an oil-driven super cycle, even though all the commodities benefited. But it was one driven by, GDP growth. It was like a positive sense of why we use energy, as opposed to maybe that negative framing of geopolitical insecurity that from the Arab oil embargo years. I think, as you alluded to, like in the past couple months, we published it last week, we've been thinking between AI power demand driven growth, aging OECD grids, and then economic improvements in the developing world, the wealth gains and the energy that comes from that. Power is really the center of what the issues are today, that we're going to have to go through a major CapEx cycle. On the power side, it'll probably similar to the BRICS, impact and benefit all the different commodities, But at the core, this is the first super cycle I'm going to say is less oil driven as kind of the core issue and more driven by the need to add to our power grid and power infrastructure. So maybe I'll stop there, but I think we're in the early days of what I'm going to call the third major super cycle of my lifetime, this one driven by power.
And when we're talking about power, there's a lot more fuel sources that we could use to power the grid, everything from oil to renewables to natural gas, coal, etc. Can you outline how impactful this is for oil versus gas, as a motor fuel mostly versus other fuels?
And absolutely, and I think a few different thoughts here. Part of why we focused on power is at a global level, power demand, electricity demand has been growing faster than, let's just call it, fuels demand. Both have been growing, but electricity has been growing at a faster rate. For individual countries, it kind of varies. You made a really important point in your question, which is you use a whole bunch of different sources to generate power, and I think each of them will have their own supply, demand, and price and margin outlook, whether that's coal or natural gas or nuclear or solar, wind, batteries, and so forth. And you know, one of the things we are escaping that I did not cite as a super cycle was that sort of energy transition period we were in, kind of from 2020 to 2023 or 2024. That energy transition narrative and mindset, it is what motivated me to start writing a blog, Super Spiked. It was in many respects kind of a protest, if you will, at what I thought was the failed ideology of what energy transition meant. And I actually think this sort of AI driven boom, and it's not just AI, but it gets the headlines, has been really one of the key catalysts to ridding ourselves of that energy transition mindset. And let me just spend 1 second on that, which I think the energy transition, as most commonly understood in recent years, has been we're going to get out of fossil fuels, go only into renewables, and we're going to do it by some very quick time frame, 2050 or some other year, and we're going to have to do it to solve for carbon emissions. And I've always said we can have different views on how aggressively or the urgency or what are the consequences of having carbon continue to go up. But my viewpoint has been no one actually solves for that as their primary objective. There's no country, there's no person that says this is what I care about most, and nor did I think, therefore, it was an organizing principle for energy. All anyone cares about is if I turn the switch on, if I want to move my car forward, do I have energy? It is energy availability and abundance, which unfortunately not everyone gets to benefit from. I'll use the line, there's the lucky 1 billion of us, American, Canadian, Western European, Japan, Australia, New Zealand, maybe South Korea, that use a disproportionate amount of the world's energy. And then the other 7 billion people on Earth, which are using a fraction of the energy today, but are in various stages of improving their economic well-being. That energy transition mindset said there's a limit. And we're going to limit wealth. We're going to limit it to, and we're going to divide up this bucket and we're going to emphasize renewables. We're going to de-emphasize coal and oil and gas. And my viewpoint was always, it doesn't matter what I think as American, what you think, Doug, as an American, the developing world, China, India, the rest of Southeast Asia, and increasingly the 54 or 55 countries of Africa, they're going to choose for themselves how to improve their economic well-being in the same way we did. And that, therefore, is going to mean we're going to need all forms of energy. And that is going to be oil, natural gas, coal. It's going to be solar plus batteries. It's going to be wind. It's going to be hydro. It's going to be all these things. And through the significant unmet demand that these countries have, there's also going to be motivation to develop new technologies. So we've never been sort of for or against any specific technology. What we try and spend our time doing is understanding is what are the supply demand balances? How do the growth rates differentiate? But as an organizing principle, what is the prospect for countries moving up economic and therefore energy S curves? Your economy improves, you use more energy, and then how will they meet that demand? And I will just say that, again, I think it's going to be the power sector and electricity generation, which is going to define a lot of how we organize and how we think through what is the energy we need, what is the timing of it being developed, and what are the opportunities ultimately for investment in the sector.
So when we're talking about the super cycle within the power business, where do you see the constraints and the bottlenecks where there could be pockets of extra pricing or other long backlogs where companies could really benefit, or where they're going to need capital, need to attract capital through better pricing and better returns over the next handful of years?
One of the trickiest things about power specifically versus, say, oil or copper or natural gas or any of these other um, input sources, whether it's metals and mining or oil and gas and this kind of stuff, including coal, is that power is very local and it's very regulated. And therefore, the price signals and how to motivate this stuff, it's not as straightforward as sort of oil and gas specifically, where there's too much demand relative to supply, inventories draw down, spare capacity depleted, and people debate, oh, is demand too high or not? Is supply going to come on easily or not? There's lots of normal debates, but it ultimately translates in terms of a price cycle, a return on capital cycle. We could debate, and we did 10, or excuse me, no, 25 years ago, is Russia Arctic the next future supply source, or oil sands, or Brazil, or deep water? It turned out to be US shale oil, which for the first half of that super cycle, no one even contemplated as one of the possible solutions. So all of that sort of price signal, investment flows, I'm not going to say it's just easy and straightforward, but it is different in power where there's a lot of local regulation. In our country, the United States, lots of individual states have significant jurisdiction over who and how and what timing power gets to be developed. And the same thing holds to different degrees in different countries. So there's, it feels like right now there's a recognition, the ability to easily meet what for the first time in now 20 years is growing load growth, i.e. power demand is increasing. How are we going to do that? We've seen like independent power producer stocks do very well where they had a bunch of capacity that now might be benefiting from higher power prices, where that's more like the oil and gas industry, if you will, where there's a kind of a very direct price signal. How will the regulated utilities respond to this, where they face a lot of pressure to not raise the power prices on all the consumers that make up their jurisdictions? Right now, gas turbines are in a significant backlog, and that benefits a handful of the, I think there are three main companies, GE Vernova, Siemens, and Mitsubishi Heavy, that produce these gas turbines. We've got power infrastructure companies that are going to help lay all the transmission lines and infrastructure and so forth. So I think it's a really diverse area. My background is more on the oil and gas side. I actually defer some of the specific investment calls to people who are better suited in power. But again, I think my observation is, in contrast to energy transition narratives, or in contrast to early in my career where oil really was the driver, I'm going to observe that I think in this case it's power, it's AI, it's wealth gains, it's aging grids, and all these kind of things. And therefore, trying to dig into the question you just asked, where are they going to be the biggest bottlenecks and tightness? And I think that's all stuff we need to do more work on, and the market's going to do more work on.
So you brought up a great point that over the last 10, 20 years, the power load growth has been roughly flat at 0%. We've been more efficient with all of our appliances, et cetera. Now we're looking at, between AI and maybe EVs and other things, we're looking at probably a 3% CAGR for the next handful of years. What fuels do we need to get the power? Because we got to get the power from somewhere. We're going to start burning oil again. We're not going to retire coal, nat gas. We have a lot of it in this country. It's stranded. Renewables, we've been doing more of, getting the costs down. That might have hit a little bit of a roadblock recently with some of the changes in Washington. But I'd love to get your thought on what hydrocarbon or renewable is going to fuel the increase in the 3%, or maybe we'll just be more productive.
Yeah.
But what are your thoughts?
And I think it's going to be a mixture of all of them. And of course, when we talk about flat load growth to now somewhere between, I think my former colleagues at Goldman Sachs are at 2.6% US power demand growth. Some are higher at 3 and even 4%. Some are at 1 to 2, but some positive number. I'm going to go with the Goldman Sachs number, 2.5%. Your 3% number is very similar to that, but those are US numbers. So again, globally, sort of a related but different question. And in the developing world, power demand has been growing at 2, 3, 4%, depending on the year and the jurisdiction and so forth. So for the U.S. question of where we're going to get our power from, we've gone through these cycles. So if you go back to the 70s, oil used to be a major part of our power generation mix. And the result of that Arab oil embargo, we stopped using oil in power demand for the most part. Back, I guess it would be in the 80s in reaction to the 70s. And so that super cycle in oil led to coal, natural gas, and nuclear taking share. It was in the 2000s, and I guess around the time of the last tech revolution, the internet bubble, that natural gas power took a lot of share from coal, where shale gas lowered the cost of natural gas power relative to coal. And so we saw a big mix shift from out of coal into natural gas kind of over the 2000s and in the early part of the 2010s. And then more recently, of course, it's been solar and now solar plus batteries and to some degree wind taking some of the future, some of the share from all of these places. And so as we look forward, I think one of the things that's been happening is we've been retiring a bunch of coal plants and we were talking about retiring nuclear plants. It's really hard to understand how that makes sense at the macro level, maybe for individual utilities or states. Something is aged and it's not worth reinvesting to keep it running and so forth. So there may be some individual decisions that change. But we've gone from 20 exajoules per year of coal demand, this is about 15 years ago, to just 12. That's at a time when global coal demand has been growing. So if in part we've done this because of reaction to shale gas, that's economics, that probably changes. But if in part it was due to kind of quote climate and carbon concerns, I'm not arguing whether we should or should not care about this. I would just simply observe that in China, coal demand is growing. In India, coal demand is growing. In rest of Southeast Asia, it's growing. And the amount it's growing in these other areas swamps even the retirements we've had, where therefore global coal demand is growing. My point of all that is to say, if there's been specifically an environmental opposition to coal, I'm not saying we shouldn't figure out ways to scrub it and try and make it as clean as possible from an air pollution standpoint. But to me, it strikes me that one of the things to look at will be when do we start unretiring some of these coal plants in the same way we've seen nuclear deferrals of retirements and restarts of even things like 3 Mile Island, which I remember sort of as a kid as being a traumatic event. And now we're restarting those kind of plants. So it's a long-winded way of saying we're going to need all these things. But the idea that we're going to sort of just continue to retire coal, I suspect that will reverse. We're going to continue to try and invest in nuclear. The current administration has had a number of policies to try and further promote growth in nuclear. We have some new technology companies, SMRs, that are pre-revenue. The market caps are very high. We could probably debate, we could debate the validity of all that or the timing of it, but there is a need for new technologies. Natural gas is going to be part of the mix. Right now, we got the issue of the turbines are sold out for a whole bunch of years. And therefore, I think solar and batteries and wind are going to be part of the mix as well. Should they be all the mix? Absolutely not. But should they be zero the mix? I don't think that's going to be the case either. They're going to be a portion of the mix going forward. And then lastly, you mentioned, and I don't want to skip it, is efficiency gain. It sure seems like the desired growth in power demand is going to exceed what we can actually do, given how state and local regulations play such a big role in transmission lines and all these kind of things. And I suspect the chip companies, not just NVIDIA, but all the folks, will figure out ways to make chips less energy intensive going forward because the power won't otherwise be there. So I think, demand response, all these kind of things, we're going to have a whole bunch of different things we're going to have to do to try and balance supply and demand. I think the hard part's going to be, it's not as straightforward as the oil cycle where the oil price went from 20 to 100, and there was no doubt that you had to lower demand and raise supply or some combination of the two. It's trickier with power because it's regulated and it's state by state and all this kind of stuff.
So we might not get a traditional capitalistic response where high prices lead to more investment because they can't really raise pricing right away. So we could actually have an imbalance where people go off grid to power their data centers. And we're seeing a lot of the distributed power. I mean, I think half of the OFS sector is now, moves, their stocks now move on distributed power announcements as of this quarter. And I know you're on the Liberty board and they're one of them. So we'll talk about the rest of the industry except Liberty. What are you seeing in terms of people solving the problem for getting power to a data center despite the long lead times of regulation to get not in my backyard power plant, turbine, power lines, but there are other ways they can do it and just get remote power. I mean, they've been doing it in the frac world for a while. They're on these remote sites in the middle of Texas and they have a lot of fuel and they just fire up some Cat engines.
It's a great point you're raising. I'm glad you raised the will we have to be more efficient, and now you've raised this. What are all the other things you can do? And so if we, I think we rightfully have regulated power prices. I hate to say that because I'm definitely an oil and gas guy and not a power expert. I'm sure there'll be some power executives who say, no, that's the whole problem. We have regulated power prices. maybe what I'd say is we do have them. And so then the question is, how do you get the response, which is what you're getting at? And to see all of these oil service companies across the space broadly start to get, and you're 100% right. I mean, they're almost certainly moving on their power news as opposed to their legacy oil services businesses. Probably for the best, given activity is a little tough right now in the oil space. And but it is an example of a capitalist response, right? Here's a business opportunity. There's clearly a need for it. I think as investors, you have to judge, does this company have expertise? Who's running these businesses? Should we have confidence in their ability to do this? But I think it's one of the lessons from commodity businesses in general is that when you have an imbalance, it does get resolved. Now, the debate would probably be, will it all be resolved by the end of this year? And that's where we're going to say no. In energy, and I think it's going to apply to power, cycles are 10 to 15 years up, 10 to 15 years down. The half cycle of those cycles are probably relevant. So I'll always say that China BRICS, which was kind of a big career call for me, the whole cycle went from 2004 to 2014. It was 2014 when oil crashed back to 50. But the best days were kind of over by 2009, 2010. And you could debate 2008 versus 2010, but let's just say, for simplicity's sake, that cycle actually peaked in 2010 in terms of where the stocks kept outperforming and you definitively wanted to go after new supply. The oil stayed at 100 for 4 years from 2010 to 2014. The sector slowly underperformed until it crashed in 2014, the end of 2014, but returns on capital were falling. And so we need to have some evaluation of when is the half cycle of these super cycles. And so when I look at power, I still think we're in the early days. I think a lot of what you had just asked about, new companies coming in to different kinds of businesses, maybe there's chip efficiency gains, all these things will absolutely help resolve this, but these things also take time. So I'd guess that we're 1 year into this thing. ChatGPT was announced in late 2022, IPP started moving in 2023. And I'd say some point, in the past year, we've kind of recognized, hey, we're going to need a whole lot more power, but we're just starting to formulate what these solutions are. And they're probably going to be solutions that we don't know about yet, just like we didn't know through all of the 2000s until 2010 that shale oil turned out to be the answer for that oversupply situation, or excuse me, undersupply, too much demand situation in oil. And so it's quite possible we don't know what the power solutions are going to be this time.
Yeah, and then I think that's a great example of capitalism coming in the distributed power space, and these companies that were getting low returns on capital or never really earning their return on capital unless they were the top quartile
Yeah.
operator now have the ability to earn nearly 20% returns on capital with a term contract with very low risk. Now, people want to know, is this a permanent solution or a band-aid until they put in a big power line? Do you have any thoughts on the industry there for on the longevity of this new little mini sector? Is it a band-aid or does it have legs?
I think that's actually a great question. So I think, so like one of the things is like, what is the sign that there's too much enthusiasm or things are going to roll over? Again, if I go back to the China BRICS, I now show this what I call quadrilateral of death for oil prices versus returns on capital, which I'll explain it on this webinar, which is initially for 5 years, oil prices went up and profitability went up. Then for another 2 years, oil prices went up and profitability was flat. That was the warning sign. And then for the next 5 years, oil prices stayed high and profitability collapsed. And what is the equivalent of that this time? And I think it's getting to what you just asked, which is what's a band-aid and what's sustainable. So I think, you know, ideally, I think everyone would prefer to have grid power for the purposes of that's how I can feel most confident in 24/7, 365 reliability. So I think one of the questions for these newer businesses would be, how is your power going to compare at a price level with the grid? If there's power price inflation, can your solution stay competitive such that even if, let's just say, the grid, quote unquote, comes to an area that currently is underserved, will your power still be needed? And if it is needed, will it be competitive? And so from a whatever the prior price turns out to be kind of thing. And so what kind of contracts do you have? What are the duration? How do you feel good about the buyer of that power? What are the alternate uses? So Maybe it's a data center that wants it today, but are you in an area where there's population growth or other reasons for why there'll be future power demand growth? That could be an example of why being, somewhere in a city might be different than being, say, in the middle of the Permian Basin, where there's a lot of cheap energy, but there's not a lot of people, and therefore there's not a lot of backup power load. And so it's hard to stereotype this stuff and say, if you're in a city with this kind of power, you're going to be great. But I kind of think, to me, the analogy is, and it's something you said, which is who's going to be at the low end of the cost curve? And probably the equivalent in power would be who's going to be at grid parity pricing in 5, 10, 15, 20 years. And you might end up making some assumptions that that price is only going to inflate, and maybe it will, or maybe it won't. We all know that some of the oil projects that kind of needed $80 to $100 oil didn't work out when oil fell to 50. And it's not going to be a perfect analogy for power, but I think who has a real business, who's going to be at the low end of the power cost curve. I think these are all, quality of contracts, quality of load diversity. All these, to me, strike me as sort of important considerations for making an investment. But I always want to keep an eye out on what is not being looked at today that will suddenly spring. Like, again, there was a huge debate: deepwater West Africa versus deepwater Brazil versus Canada's oil sands. Like, none of that was the right debate. The debate was something no one thought about, which was shale oil, and that undercut everybody. And that also had an ability, when the price fell, to be able to lower its cost. Shale needed, for sure, $100 oil when it first started. It probably still needs 70. The companies thought they needed 50. But either way, it was able to right size its cost structure down in a way that other long lead time projects were not. So even in this power example that we're talking about, who might have a variable solution that, if it turns out that power prices don't only inflate, and maybe in 15 years they start to deflate or go down for whatever reason, or the utilization rates start coming down, which is probably the more likely thing, how will you ensure that you still have a place in the market? And I think these are the kind of things we're going to just, I don't have an answer, we're going to spend time looking at. So,
Well, one of the solutions, or the more environmentally friendly solutions, mostly on the solar side, there was a lot of incentives, and on the EV side, and some of those incentives have now gone away despite Elon's, $300 million investment in the campaign. Those incentives for Tesla and the EVs have gone away, but they were around for almost a decade. They really lowered the cost curve and the production cost and got the industry up and going at a time when they really wouldn't have got up and going without those incentives. Was it the right time to take away those incentives? Is the industry at a point, talking about solar and EVs, where they can now, the technology has come far enough where they can compete effectively to be part of the solution for the overall power grid?
I mean, I think for all these technologies, I would probably caution against sort of the blanket statements. And so to me, it makes sense that ERCOT, the Texas grid, is used in a whole bunch of solar and batteries. It clearly has a lot of solar radiation. It makes sense to me. When I see, like, in the New Jersey governor's race, they're saying, one of the candidates is saying, "Hey, Texas is using a bunch of solar, so should New Jersey." My comment would be, is I'm pretty sure New Jersey is not as solar radiant as is Texas. I don't feel like you have to be a geography expert to know that, let alone if you go further north. And so if you did actually want solar, then perhaps it needs a subsidy in some places and not in others. But I think overall, for technology to truly scale, it's going to need to stand on its own. People critique, does the oil and gas industry get subsidies? I always say everyone just needs to be an oil analyst, and you can see all the cash taxes these companies pay. There's no doubt they get intangible drilling tax credits, which might result in deferred taxes, but that is not a tax credit. That's taxes you will owe when you stop drilling and/or oil prices go up and so forth. So, ultimately, these technologies are going to have to stand on their own. So if I take as an example how significantly China has come down the cost curve on EVs as an example, in China and in the related countries around China, they're able to sell EVs at very low prices. Now, whether the government's de facto supporting these companies, we could have a whole webinar on that. But I feel like there's no doubt the cost of Chinese EVs have come down, at least in part due to their own learning curves and so forth. And so that is going to stimulate demand. So I think for a technology to truly scale, it's going to have to stand more or less on its own. Solar strikes me as something where people say how low the variable costs are, and I think that's true. And if you don't have to pay for reliability, then solar for sure is very cheap. Then when you start factoring in the cost of reliability of whether you have backup natural gas, backup coal, backup whatever, or how much batteries do you need to truly be able to cover both daily and seasonal load variability, then I think we can debate how low cost solar truly is. But on the other hand, I don't like making the blanket statements because they're absolutely, for example, I think the Middle East and India are two places that are going to use a whole bunch of solar and batteries. I don't think like Northern Germany should be a solar haven, as an example, right? And so, um, again, I'll go back to I think we're going to end up using all these technologies. There's some initial incentive motivations we need, but we've had solar subsidies for a long time. It seems like it's going to be better for the industry to have gotten rid of them because then there's no debate it stand on its own. There's no debate this isn't climate policy for why we're doing solar. It's because you can readily get power. I think the cool thing about solar is, and this is true for a lot of the developing world, which is once you have your solar panel up and running, you may like or not like where it came from and all that went into it, but it is a domestic source of energy. So as long as you can have the system to ensure you get reliable solar, either because utilization rates are higher and or you have battery backup, or more likely you have coal or natural gas as your backup, nuclear as a portion of your mix, then I think solar's got a huge opportunity, especially in the high solar radiation areas of the developing world. India, large parts of Africa, and the Middle East come to mind, but probably parts of South America too, as being really good, and therefore our South and Southwest, Texas and Arizona.
And I also want to touch on the second part of the question on the EVs. We've had a lot of
Yeah.
incentives in the US to use EVs. Obviously, now you're plugging into the grid for the power versus before you would have been going to the gas station and using oil. Now, China, on the other hand, obviously has a lot less oil. They import a lot more. I've seen that in your charts. And they're obviously going a lot faster to develop EVs because they have coal, which could power their grid. But how much demand has been transferred from to the grid from the gas station on this switch? And is that part of our solution to go back the other way potentially?
In the US, it's not a very large number because our EV sales are just a fraction of what they are in China. I will say the sort of EV impact in oil demand globally, I think most people generally overstate it. I myself, just for the record, am a very happy EV driver. I've driven a Tesla Model S first, now a Model 3 since 2015. Wow, I've actually driven one for 10 years. And I personally hate driving gasoline cars. I prefer the one pedal driving. I prefer the instant acceleration. And it's always an adjustment to go back to an ICE vehicle when I have to drive one. But for me, it's consumer preference. I'm also, retired Goldman Partner, so very fortunate to live in a house where I can plug it into home very easily and so forth. So I don't think that for everyone. I feel like there's been a big mistake on the part of climate activists and folks who cared most about carbon emissions to say this is, quote, the answer to getting our dependence off of oil. And I don't think that whole framing was ever going to work out if the goal was to reduce emissions and to lower oil demand. I will say that vehicle weight will have a much bigger impact on especially gasoline consumption in the US than will trying to replace a Lincoln Navigator with a Rivian or equivalent law. I never understood why we're giving bigger EV tax subsidies to EV SUVs. That to me, there's nothing climate friendly or environmentally friendly about that. And I think getting out of this sort of
For
ICE
Americans,
versus yeah.
we love our I mean in Texas, you don't drive your Tesla and when you're good on there, you must rent a pickup or have a wrap.
I
Right?
actually generally don't like driving big cars. I do have my wife's old BMW down there. And I think to me, the reason to have an ICE vehicle in Texas would be if I did want to drive longer distances to check out Texas and so forth, then I definitely don't want an EV. In the Northeast, most of the driving distances are pretty short and I don't worry about it. And when I do have to drive long distance, when my parents used to live on Cape Cod, I took the ICE vehicle just because it was such a pain in the neck to charge it along the way, even though there's ubiquitous chargers along like I-95 and so forth. It's just who wants to wait a half hour to charge? And if my parents didn't have a charger, which they didn't, then I had to, again, once I got there, go charge somewhere and so forth. So, I think it was an unhelpful debate that people had. It's part of that quote energy transition mindset that we have to mandate this and avoid that. And I think EVs are going to be a decent mix of the fuel vehicles, in part because, as you said, countries that import a lot of oil, they'd absolutely rather burn coal and through their power generation than import oil from whether it's Russia, Saudi, or for that matter, the US and Canada. So they're going to try and avoid oil imports. One way to do that is to ramp up EV sales. We're seeing that in China. We're seeing it in other Southeast Asian countries. But make no mistake, their economies are at such a lower starting point. Their unmet energy needs are so massive. They're absolutely going to be using ICE vehicles along with EVs. And of course, gasoline, which is what EVs replace, are only about a quarter of the oil demand barrel to begin with. Never mind how significant I think the wealth gains, the economic development, if you will, is to come in some of these areas. So I think we're going to be like with power on oil and on transportation fuels, all of the above. In this case, it's kind of two choices. And I'd say from a policy standpoint, if people really cared about policy, if people truly cared about the environment, you would advise the developing world to put vehicle weight restrictions. I'll give a quick stat. In the US, we've gone from 70% light cars to 70% SUVs over the last 25 years. And as a result, the 3% improvement in CAFE standards, corporate average fuel economy, the actual number has been 0.2 to 0.3%. We've entirely missed the fuel economy gains that did come from driving more fuel efficient vehicles because they got heavier, which therefore offset the inherent what did come true. Like again, an SUV today is more fuel efficient than one 25 years ago, except we now drive a lot more of them than we did, 30 years ago. And there's a huge opportunity in development. And so like if one takes it out of we're counting carbon emissions to, hey, we're trying to limit our oil imports, that in part gets you to EVs in the developing world, but it also gets you, and a country like India ought to think very seriously about vehicle weight restrictions, and then we'll see what people choose. Now, EVs are not light vehicles, so that then gets to how much power they're going to use, and if you're going to have AI data centers. So it's even I am oversimplifying this discussion and debate, but I will just say that you know if you could ban EVs as opposed, excuse me, if you banned SUVs instead of buying in ICE vehicles, you would actually have a real environmental policy and say ban SUVs whether they're EV or ICE. No one's going to do that. We have driven an SUV. I'm not trying to suggest I am some beacon of morality on this point. All I'm saying is if you actually wanted an environmental policy, you would ban SUVs as opposed to banning ICE vehicles.
It's a great point on how the regulation on efficiency maybe could be adjusted and solve a problem a little bit differently. That's interesting. And when we think about the overall impact, coming back to the high level power demand growth going from call it 0% to 2.6, 3% roughly, how much of that growth is from AI versus reshoring or other areas of improvement?
It's a great point to emphasize, which is I think AI gets the narrative and the hype, and I think it's real. It's going to grow a lot, but it is all those other things as well. It is reshoring, reindustrialization, and again, if we're just focusing on the U.S. number of the 2.6% Goldman Sachs estimates, they attribute 1.2% of it. I think I'm right about this. People should refer to their research to AI, and then the rest to these other trends where for 20 years we had economic growth, but LED bulbs and all these kind of things kind of offset. We basically had a massive improvement in efficiency in electricity, which by the way, we have never seen in oil. We've seen steady efficiency gains, but not a step change improvement. In power, you did see it. And now you've kind of run through a lot of those things. And then now we've got some of these new sources of, some amount of reindustrialization, data center growth, and all of these kind of things. And so it's an important driver. It's a driver. I'll bet it impacts the PE of these stocks more than it impacts the actual. So if I stick with the Goldman Sachs numbers, if 1.2% of the 2.6% of US load growth comes from AI, I'm going to say for a lot of the equities, the bulk of their PE expansion is coming from AI. So I think AI captures a lot of the kind of the mind share for the power sector and power demand. But in fact, it's one of many drivers. It's not the driver. So
Great. And Arjun, when we were emailing over the last couple of weeks to set this up, you were on the road a lot, traveling for I think 3 weeks, doing field research, hearing from the actual people at the facilities and the managers making the decisions. I'd love to get your top 2 to 3 takeaways from being in the field.
I mean, actually, it's striking to me how all anyone wants to talk about is actually the power side of the equation. So I did speak at a couple power events, as well as with the consumers of power, and I think there's probably just a couple of things there. I mean, both myself and most of, not all, but most of my colleagues have varied in. Most of our careers were more on that traditional energy side of the equation, oil and gas, upstream majors, refiners, and that side of it. A few were not, but most were. And some of the folks who have signed up for us, including power companies and some of these, let's just say, leaders in AI kind of people, um, when I asked them, hey, we're definitely oil and gas people. Why do you want me to speak at your event? They're like, we like the historical perspective. We want the perspective of energy more broadly. We don't want to just be narrowly focused only on what we already know best. We're not going to utilize you, Arjun, for like a tenth of a percent on like load growth forecasts, but we do want to know what the lessons were from the China BRICS expansion. We do want to understand the natural gas space and what's going on with the resource there. We do want to understand. So like, it's interesting to hear sort of just how interconnected things have become. And like for most of my career, it would have been energy analysts and energy executives and maybe generalist portfolio managers who would like debate and discuss energy. Politicians would occasionally come and say, oh, those evil OPEC cartel people or the evil big oil companies are causing gasoline prices to spike. I don't think most people ever truly believed that. It was always kind of supply demand, and maybe they made some poor policy choices, or maybe they made some better ones. But it was always sort of an abstract argument, and no gasoline consumer, because there's so many of them, right? Everyone drives their car, is going to sit down with like a large oil company to like discuss their plans for expanding their refinery. That is very different in power. Right here, you have these discrete users of power, these data center hyperscalers or companies that want to build out that space, who then specifically want to know how they're going to get power to their facility. And if you're a large industrial customer and you're kind of reshoring or doing whatever, expanding your U.S. footprint, you're going to say, well, if I build this plant in Louisiana or Texas or New York or some other place, where is the power coming from? So suddenly, the consumers of energy are very directly involved in this in a way that we have not seen historically. It's actually what gives me the most optimism because you take it out of the political realm of, oh, I, as a politician, do not want to be blamed for high energy prices, whether it's gas and electricity. So I'm going to blame a high profile group that I know everyone can easily hate. And maybe that's utility executives, maybe it's oil executives, maybe it's OPEC, whomever. Where in the case of a large industrial or tech company, they are specifically saying, hey, I don't care about your political BS and all this kind of stuff. I got to know how I'm going to get power today, and therefore I'm going to understand it. I got to tell you, I've been very impressed with how they're all obviously, if you work at a big tech company or for that matter a big industrials company, you're a smart person. But I got to tell you, I've been impressed. Energy can be very specific. We're very in the weeds. If you're not an oil and gas or utilities analyst, you may not know all the details. They've ramped up significantly. They've hired people from the traditional energy industry to work at their companies, and I'm honestly I'm blown away by how much they've ramped up the learning curve, and that gives me hope. It gives me the most hope that we might actually have a chance to have sensible energy policies, at least in the United States, or at least not horrific energy policies, which was the path we were headed down in the prior several years. And by the way, I don't mean that to be partisan. There's some policies with the current administration that I support. There's some that I don't support. In the prior administration, their policies I definitely did not support. Maybe a few that I did support. All these, all these politicians have a lot of cons and a few pros. And when it comes to energy, most tend to be undereducated on the topic. And again, what gives me hope is that it's going to be these big tech, $1 trillion company, big industrials, multiple hundreds of billions of dollars of market cap companies who are now involved in the discussion. I think that's going to be a very good thing.
I mean, the data centers are getting so big, they're going directly to the land and they're integrated in the Northeast, essentially to commit to get the power, get the gas to their data center. And, we're restarting nuclear. So we're kind of going around the regulation and saying we're going direct. And these are mega contracts that we're seeing there. This is another solution, I think, that we're seeing where capitalism is saying, hey, the grid's not going to be here. They're not going to be here in this way. How can I solve this problem myself?
Yes and no. I think a lot of what you said is correct. I
Or,
think I think the part that I need to do more work on is I think we'd like it to be true that, hey, if the grid's not there, I'm just going to do my own thing. And I think for certain loads and for certain people, that is going to be true. Microgrids is kind of a word we all use now, and it applies to some situations. But depending on your size, you're going to want to have grid power and grid reliability. And you might need transmission lines. And like, are you going to pay, as the company, pay for that transmission line and 100% of it? Or are you going to try and have the ratepayers, or they now call them consumers, but the ratepayers of these territories continue to bear a disproportionate burden? Or because you've got a 30, 50, 200% return on capital as a big tech company, are you going to bear that? It's like there's a lot in power that is, quote, socialized. And by socialized just means spread over the entirety of the consumer paying base. And I think how those costs get divided up is a big question. And I don't know, everyone wants 24/7, 365 power as the number one objective, and then as low a price to pay for that power as possible. And doing that at scale without the grid is a real challenge. To me, it is the political fight of how are you going to divide up the costs that have historically been socialized disproportionately, maybe disproportionate not the right word, but there's a large number of retail ratepayers. And your transmission lines, a lot of those costs have been divided up by however many tens or hundreds or millions of people that live in your service area. And so if suddenly you've got a big AI data center load, are they truly going to be off grid? And I think you've seen some dynamics in some of these cases. So I think you're right that innovation is needed. Totally support that. I think what we need to be careful about is are they truly off grid, and are they truly not, excuse my language, sucking up the resource that regular people are paying for? Not 100% my area of expertise. So I don't want to overstate my knowledge here.
What about the cost competitiveness? I mean, I've been reading some stats that the cost of electricity in China for some places, again, it's a local business, is half of what it is in the US. And there are other stats that say some of their LLMs are 80% more efficient. And obviously they're burning coal. We have other fuels here. They have different environmental regulations. But how do you see globally the US competing on an electricity cost when we're going to need so much of it for AI?
I think this is probably the critical question of sort of US competitiveness versus the rest of the world. And I think the two opposites that are easiest to kind of highlight are China on the positive side, which you just highlighted. And I think you raised it, and I agree with it, which is coal has been a dominant driver of their power generation mix. They've got a lot of it within China. It is low cost, it's jobs, taxes, all the bureaucracy, all this kind of stuff too. But it has been reliable, 24/7, 365, very dependable. They've had some air pollution problems that the citizenry, as they've become richer, have said you got to deal with that. So they've started to deal with the air pollution problems that does come from burning coal, the traditional air pollutants that we think about. But it has resulted in a huge ramp in their manufacturing. Is it a coincidence that China's become factory of the world and is now 50%, 50% of global coal demand? And it is the reason coal demand has grown every single year for all of time, even though for a couple, periods it looked like it was leveling out. And then China has new reindustrialization and it grows further. And we contrast that with Europe, which has in part treated carbon emissions as its organizing principle. They are blessed with a lot of coal. They don't have some other stuff that like oil and so forth. So I get some of the drivers of moving to different technologies, but you basically have outsourced European manufacturing to other parts of the world, most notably China. Not obvious to me that that saves on emissions. It definitely doesn't. Europe still has a lot of built-in historical wealth, but on the margin have been underperforming economically. And so to me, they clearly are uncompetitive. And I think the US, it varies to a great degree. I think we've been very competitive on power prices every time I've looked at the subject. I think China is very competitive today. And I think that is our big challenge is what mixture of nuclear, natural gas, coal, solar, wind, batteries, and hydro is going to ensure that we have the most competitive power prices as possible. What do we need to do on transmission line and permitting reform to ensure we don't have 5 and 10 and 15-year delays where maybe part of the reason things are expensive is because you go through all these roadblocks and all these litigation and so forth. But we also don't want zero environmental regulations. We don't want to we don't want to do run over people like China presumably does to get things done. So what's that balance between having environmental and labor standards and having the right to sue when things don't go well versus not getting so bogged down that the prices are way, way up and so forth. I'm going to be optimistic that we will figure this out as a country. I believe we are competitive on our power prices today with China, but I think we're at risk. We would risk becoming less competitive. And I think we should make sure we do everything in our power to ensure we can be as competitive as possible.
Great. And I want to switch gears a little bit to your views on oil and your somewhat contrarian call that we're in the bottoming phase, whereas at least in the near term, people are pretty concerned about a glut. OPEC has opened up the valves, and I'd love to get your perspective on what you're seeing there from both a demand perspective. It's traditionally been, Asia and China, and what you're seeing from a supply perspective from production, and then also from, call it, the Middle East, reversing their quotas.
And it's funny. So part of it, I think, actually ties into the power conversation, where I suspect oil demand is closer to what OPEC research through the monthly oil market report projects than what the IEA projects through its equivalently sounding titled oil market report. Whereas as when we get to 2026, OPEC research has oil demand 2 million barrels a day higher than does the IEA, and it's kind of a buildup over 3 years where they have a higher growth rate, and therefore so the IEA's got like 4 million barrels a day of oil oversupply projected for next year, which is worse than COVID. To me, it's just not common sense that right now is worse than COVID. Half of that sort of 4 million barrels a day of supply build comes from, I think, them underestimating demand. And you take an example of, like, for the first time in my career, or 33 years, African oil demand numbers are becoming noticeable in terms of positive revisions. China is almost certainly kind of dumping or selling at a low price renewables and other forms of power generation into Africa. And it seems like it's translating very directly into higher oil demand. We need to do more work on that. But I think part of, like, the whole AI and power story is one of economic growth. So if we had 4% global GDP during the BRICS and China expansion years 20 years ago, we've kind of decelerated to sub 3% global GDP. I think AI and power demand growth, both for wealth gains and for AI data centers, is going to be one of the upside risks to that global GDP number, which translates into oil demand. So I think oil demand, number one, is a lot better than expected. Saudi and some of the leading OPEC countries, they presumably transferred some of their below ground inventories into above ground inventories in places like China with strategic petroleum reserve bills. I don't I, like People treat the China SPR bills as if it kind of doesn't count. And boy, we'd have massive oversupply if not for that. But I'm like, well, it used to be below ground in China. It's now above ground in China. I don't understand. Oil's still not, like, in the normal market, if you will. I don't know why that is somehow bearish. Doesn't have to be bullish, but I don't understand how it's bearish.
Is there been,
Yeah.
you're kind of saying below ground in the Middle East versus above ground in
Correct. To me, that's a wash. Now, one's controlled by Saudi, below ground. The other's controlled by China. It actually may still be below ground based on how they do their SPR. But one in sort of a consuming country. Like, to me, what is the difference between that? Now, if we're going to make the call that Saudi at some point is going to draw down their SPR, but why is China building their SPR when supposedly they're going to go X oil demand growth because of EVs and LNG trucks? I think people are underestimating generally oil demand growth. I suspect they're underestimated in China specifically. They're underestimated in Africa and the developing world and so forth. And so I think between an overstatement, or excuse me, an understatement of demand and an overstatement of sort of oil available for the market, I get to some oversupply in the fourth quarter of this year, the quarter we're in, and in the first half of next year, but something below 1 million barrels a day versus the 4 million barrel a day number you see from the IEA. And most Wall Street analysts are probably like at 2 to 3 million barrels a day of oversupply. I will say that based on even that amount of oversupply, all those banks that have like 1/4 of $57 oil, despite having like 3 million barrels a day of oil, like, those numbers don't add up. Like, if you're going to forecast oversupply, make sure you pick the oil price that goes with it, which would be like a sub $40 number. And you're gonna have $2.5 million barrels a day of oversupply and 1/4 of $57 oil, or 2/4. Most people's numbers don't really add up, to be honest with you. I think we're through the worst of the pullback. You can always on an individual trading day, market corrects, Trump says something about China tariffs. You can always have oil sell off on individual days. But I feel like we've had the bulk of our move down from 120 at the peak of Russia, Ukraine to in round numbers $60 today. We could still have another $5 or $10, but I feel like we're in the bottoming phase is the phrase that I'd like to use. So
Got it. And what is the structure of the curve? Is there any inferences we can make about that at this point?
yeah, I mean, so the curve's gone from a backwardation, which means the spot price is higher than the out year price, which is a sign of demand exceeding supply, to one that is contangoed over a large portion of the curve, which suggests at least an expectation that supply is going to be greater than demand. Though at the very front of the curve, that's not so clear cut. But my view is that we're in sort of a modest oversupply right now, not the oil glut that is often touted out there. And I feel like the shape of the forward curve is consistent with that, where there's, again, a modest oversupply, but not the kind of steep end of the world contango that we have seen in past significantly bearish periods like COVID or the great financial crisis.
And China's the biggest consumer of oil imports in the world. What is it, 9, 10 million barrels a day, something very large. What is their history, if you know, of timing, of being able to buy during lulls in either, I've seen it in iron ore, now we're looking at oil. Is that actually a contra indicator that we could look at? Have you ever looked at that?
They certainly have the reputation of generally being smart buyers of all commodities. And you're correct to highlight not just oil, but whether it's copper or iron ore, these other things as well. And it's kind of interesting. So, like in the second quarter this year, China built their inventories by maybe zero point 0.9 million barrels a day, which is a decent number if people don't know the numbers themselves. And they did it at a time where everyone was calling for oil to crash and that we were going to have this massive oil supply gut. So, like, why would a smart buyer of oil be buying oil ahead of a supposedly further large correction in oil prices? Would be probably one question I'd have. So I think China's history is they generally buy kind of at the low end of the price range and don't buy or sell into the high end of the price range. But I actually don't have a statistical analysis of that. I would call that more anecdotal, but I think does call into question why people think things are going to get a lot worse from here when in fact they've been otherwise adding inventories. So.
I just want to take a step back, and I've built oil supply and demand models, and to me, it was too complicated for me to do. You have 100 million barrels of supply, 100 million barrels of demand, and 1%, which is 50 basis points. There's too many variables I didn't know. So, and I'm all trying to get it down to, well, is the US going to be 5 million or 6 or 7? And, that 5% that I do know. My question for you is when I thought historically, the last 10 years, roughly the narrative was the US shale added roughly 1 million barrels a day, maybe 1.5 on the supply side. Demand grew by roughly the same, 1.5. China was probably 1 million of that with a little bit of Asia, right?
Mhm.
They kind of matched, and everything else was obviously a lot of other political noise there. What does that narrative look like for the next 10 years? Where do we get the next 5, 10 million barrels of supply from? And is demand now going to only be 500,000 barrels? Is it going to be 1 million barrels? Can Africa, Southeast Asia offset China?
You know, I I think if I get back to the global GDP assumption, if we're only growing global GDP at around 3%, then oil demand is kind of 1 million barrels a day, or maybe a little bit less than that. If we get back to the 3.5 to 4% kind of global GDP, and maybe driven by AI powered demand, maybe driven by, some reacceleration in wealth gains in the developing world, then you start pushing oil demand numbers closer to 1.5 million barrels a day, or at least 1.2, 1.3. And I think you pointed out in your talk, which I agreed with, which is 500,000 barrels a day, 1 million barrels a day. You can make huge swings in supply demand balances. I think in the short term, it can be very hard to gauge these things. I think structurally, the more above 1 million barrels a day you are, and again, I think the high end is probably 1.5 million barrels a day, not 2 or 3 or something like that. Then you start calling into question what kind of oil price do I need to really motivate tier two, tier three shale? And it's probably not $60 oil, maybe it's $80 oil. Or if it's not that, do I need to go back to deep water in some of these areas or motivate new OPEC spare capacity, or excuse me, OPEC capacity that they can produce? And What are the prices that motivate all this kind of stuff? And that gets into do we need to incentivize a capital spending cycle? The historic lesson is it's usually not $10 that does it. It's usually like a 5 or 10x increase in the oil price. Now, we're not calling for that right now. I think we'd want more evidence that global GDP is really starting to reaccelerate to like my language has been we're in a super volatility market for oil, not a super cycle. We're saying power is a super cycle, not oil. I do think people are too bearish on oil in the short term, as we just talked about. But I think how do we transition from sort of like, okay, 60 to the low end of the range, but if you're telling me 70 or 80 is kind of, a good price, and anything above that's going to be viewed as a peak price, what would cause a bigger oil cycle to happen? I think I got to start with global GDP's back pushing 4%, and therefore oil demand's pushing 1.5. And then suddenly I think we really need to figure out, okay, do we need new pipelines from the oil sands, deep water cycle? Do we need to motivate, or demand destruction? Do we need to motivate that? And will 10 or $20 be enough? Historic answer is no. In the 70s, oil went from 3 to 30, and we got a whole bunch of supply and a whole bunch of negative demand. In the 2000s, it went from 20 to ultimately 150 at its highest point. But let's just say 20 to 100, it went up 5x and then settled out at 50. It settled out at 2.5x. Not dissimilar from the 70s. We went from 3 to 30, but settled out at 20. So you kind of settled out in between kind of the high point and where you started. And so if our starting point today is 60, are we going to get a 5 or 10x increase and then settle out somewhere in between them? And it's definitely not our call today, but that is the historic lesson of oil cycles, that it's not 5 or 10 bucks that motivates new supply. Now, before one becomes too bullish about all this stuff, we historically didn't have EVs or LNG trucks or LNG ships as sort of a diversification opportunity for transportation fuels. You do now have that. So maybe that's the argument for why oil doesn't go up 5x. Maybe it only doubles. And I think that's how we probably start thinking about risk reward. So
And Arjun, before you came on the podcast, I was doing some homework on AlphaSense, and they were talking about the energy sector weight to earnings convergence setup strengthening. I know you've also done some work on the relative earnings versus market cap of the energy sector. Uh, can you share that with us?
yeah, so I mean, and it's a line from my former colleague and friend and current Goldman Sachs strategist David Kostin, who will say energy tends to punch its earnings weight in the S&P 500, meaning if the earnings contribution of the energy sector is 10% of the S&P's earnings, then its market cap weight over long periods of time would be expected to be about 10%. And when I graph this out, I will notice when it looks like the sector is over earning, meaning oil prices are high, people ultimately intuit that it's not sustainable. The market cap weight is below the earnings weight, but the opposite is also true, meaning like at the depths of COVID, where no one believed negative oil prices or even the 20 or $30 low end prices were sustainable. No one was saying, hey, the S&P weight should be zero like the earnings weight, and it kind of bottomed out at 2%, which is still a low number, but not zero for that matter either. I'd say right now the sector is under earning, meaning I think the returns on capital are below what structural profitability would be. And yet the earnings weight is about 5% of the S&P 500, and the market cap weight is only about 3%. So I would argue that the energy sector should be more highly valued today at a time it is not over earning, and I'm going to argue it's under earning. When the sector's under earning, typically your market cap is above your earnings weight. Today we have the opposite. The earnings weight's higher than the market cap weight. That would be, valuation does not get a sector going. So we probably need some combination of people recognizing the oil glut isn't here, maybe even the modest oversupply that I'm forecasting for the next couple of quarters. Maybe we have worked through that. Maybe it's global GDP picking up. I'm not sure what combination it is, but I don't think we have to make some heroic oil call to believe that the market cap weight of the sector should at least be at its 5% earnings weight today. Maybe we need the Mag 7 stocks to cool down. I'm not sure what combination of oil specific and general market factors we need, but it's probably some all of the above kind of thing. So,
And one more follow-up for you when you were talking about the overall oil glut. Again, I was reading on the AlphaSense workstation earlier that a lot of the glut, or one of the anecdotes was that it's renewable diesel on the product side that was causing some of the glut, specifically from, I think it was either Valero expert or someone from that management team. When you look at the glut in the dynamics, are you referring to the oil or the oil end products and how much of it might be renewable? Any color there?
Yeah, this is a big part of it. So like whenever people talk about oil, even I am guilty of being loose at the time. It's usually liquids they're talking about. So when someone says oil demand is 105 million barrels a day, that includes true black crude oil, but also includes natural gas liquids and includes all bunch of biofuels, including renewable diesel. Natural gas liquids, which comes from natural gas production, these are things like liquefied petroleum gases, ethane, and so forth that go into petrochemical feedstocks, clean cooking fuels, and so forth. That is in oversupply. I mean, you can see it by the fact that natural gas liquids pricing is a fraction of black crude oil pricing. So when you start stripping away, okay, biofuels because of government policy have been in oversupply. There's more biofuels than what the tax credits will support. NGLs are in oversupply. When you start stripping out those two things, you do take a chunk of that sort of 4 million barrels a day of oil glut out of the market. The only people who demand crude oil are refineries. Refinery runs are more like 85 million barrels a day. So out of a 105 million barrel a day market, 80%, 85 million barrels a day is sort of true black crude oil. And those balances, when I talk about oil being perhaps oversupplied by 500,000 barrels a day or maybe a million at the most, I'm actually talking about black crude oil balances. So I appreciate your asking for that distinction.
Thanks. Yeah, you can go deep on so many topics. It's been great. Arjun, I want to start closing with, I've known you for probably 20 years throughout different seats for both of us during our careers. What have been the two most fulfilling parts of your career so far?
In terms of filling, I mean, I love analyzing the sector and the stocks and sort of having our own view that might be very different than the consensus view. I don't think one can be contrarian just for the sake of being contrarian, but it's a sector that because the cycles are long, people and the recency bias can be great because it could be like the last 3 years or in some cases 10 years have been a certain way. I feel like I've not always been the earliest, but I feel like we've done, I feel most fulfilled that myself and my team have tried to make differentiated calls when appropriate, but also not just for the sake of it. Again, I might say that we're proud of kind of the super cycle call we made in the 2000s around the China BRICS expansion. We called it our super spike call. It made my career at Goldman. But I feel like, also proud that we didn't call for a super cycle at the height of Russia, Ukraine, and we stuck with the super volatility language. So I think that sort of let's let the numbers take us where we will. I always say I have an equity research analyst mindset, which is I'm not trying to, it doesn't matter what I personally think. It doesn't matter who I vote for. None of that stuff matters. The only thing that matters is did I make the right call or not? It's a very bottom line business, right? That's used to always think about like for my buy side clients from my days at Goldman, did I make the right call for them? Is all, and that's always been, probably the most, it's been very fulfilling being an equity research analyst. And I think having that mindset of trying to get away from political or populist narratives and just trying your best to let the numbers speak for themselves and being willing to change our mind when the data analysis changed accordingly. So
Yeah, it's definitely a time on Wall Street where there's very limited interest in energy. Uh, I was talking to the head of a large multi-strat. He's like, well, if I have to have someone in energy, because it's
yeah,
right now all the alpha's being generated and the more momentum stuff, but it has its day. It's kind of a hedge, and there's not a lot of people doing the work right now. There's a lot less brain power going into it, and it's just amazing that people get this sort of access to you for, compliments of AlphaSense. So I'll close here and I'll just say thanks again for joining us for today's conversation. A big thank you to Arjun and to AlphaSense for sponsoring today's session. If you'd like to try AlphaSense for yourself, you can start a free trial by visiting alpha-sense.com/PT pitch PM for Pitch the PM. Until next time, take care.
thank you.